Most people spend their lives working a 9 to 5 job, hoping they'll eventually retire, but they have no clear plan to get there. They're overwhelmed by too many investment choices, unsure who to trust, and afraid of making the wrong move with their money. I get it. I've been investing for nearly 18 years, and the strategy that's worked best for me is investing in S&P 500 ETFs like Vanguard's VU or another low-cost option. We'll talk more about some of the best ETFs a bit later in this video, but the key is to finding one that fits your goals and sticking with it. These funds give you instant low-cost access to America's top 500 companies, including names like Apple, Microsoft, and Amazon, all in one simple investment. When I started investing, I was contributing only $100 a month. That's it, but I stayed consistent and it changed my life. It wasn't about timing the market or chasing hot stocks. It was about finding something solid and sticking with it. In this video, I'm going to show you exactly how investing $60,000 into an S&P 500 ETF, whether all at once or gradually over time, can be a launchpad to financial freedom. But more importantly, I'm going to show you how to reach that $60,000 starting point, even if you're starting from zero. Because the truth is, knowing where to invest is only half the battle. Actually building up that amount is what unlocks real long-term wealth. I'll break down how S&P 500 ETFs work, the kind of returns and income you can expect, and why this $60,000 goal might just be the number that changes your financial future. Let's dive in. You might be wondering, why $60,000? Why not $50,000 or $100,000? Here's why. $50K is great, but it's a common benchmark. I want to aim just a little higher, and $100K, that's amazing, but for many people starting out, it can feel out of reach. $60,000 strikes the perfect balance. It's achievable with a plan, and once you hit it, compounding really starts to take off. It's that first big leap where momentum kicks in, and that's why we're using it as the goal in this video. 60,000 is also a number that feels big, but achievable. It's not millionaire talk, it's your stepping stone to serious wealth building. For anyone new, S&P 500 ETFs are designed to track the performance of the 500 largest publicly traded companies in the United States across nearly every sector: technology, healthcare, finance, energy, consumer goods, you name it. What makes these ETFs so attractive? Ultra low fees. Most charge just 0.03% per year, instant diversification across hundreds of companies, and strong historical performance. The S&P 500 has averaged about 10% annually long-term and around 12% over the past decade. Over 90% of active fund managers failed to beat the S&P 500 over time. That's why I stopped trying to outsmart the market and decided to own it instead. Now here's where it gets exciting. Once you invest $60,000 into an S&P 500 ETF, compounding starts working in a much bigger way. At an average 10% return, in 10 years, your investment grows to about $155,625. In 20 years, it becomes $403,650, and in 30 years, it turns into an incredible $1,046,964. That's over $1 million from a single $60,000 investment. And if you use the standard 4% withdrawal rule, that's $41,879 a year in passive income for life. That's enough to supplement Social Security, cover major expenses, or even allow for partial retirement. And that's without adding another penny. But let's say you don't have $60,000 ready to invest. That's completely normal. Most people don't. So let's talk about how to reach that target. First, optimize cash flow. That means two things: reducing expenses and increasing income. I'm not here to tell you to skip coffee. I'm talking about the big stuff. Maybe you keep your current car longer, move somewhere more affordable, or split rent with a roommate. That alone could save you up to $500 per month. But there's only so much you can cut from your spending. At some point, you hit a wall. But your income, that's on you, and it has no ceiling. The more you grow it, the more freedom and options you create for yourself. Get promoted, pick up a side hustle, sell something on the side, freelancing, tutoring, content creation, it all adds up. Let's say at your job, you earn a $5,000 raise and reinvest it each year. Over 10 years, you're looking at over $85,000 thanks to compound growth. Step 2, take full advantage of your 401k match if you have one. If your employer offers a match and you're not contributing enough to get it, you're leaving free money on the table. Even if your 401k only offers a few fund options, most include a low-cost S&P 500 ETF. And if you don't have a 401k, no problem. You can open a brokerage account or Roth IRA with companies like Fidelity or Vanguard or even Robinhood, which I currently use for my Roth IRA, and they are currently offering a 1% match. Step 3, automate your investing. Whether it's through your workplace or an app like M1 Finance or Robinhood, set it and forget it. Even $100, $250, or $500 a month adds up fast. If you invest $1,000 per month for 5 years, you'll contribute $60,000. And with compound growth, you'll likely have about $77,000. At $500 a month for 10 years, you'd contribute the same, $60,000, but you'd end up with over $102,000. And even if you're starting small, like with $25 or $50 through micro investing apps, the key is consistency. To keep this even more real, let's look at a quick example. Take Sarah, a 30-year-old teacher living in a mid-sized city. She decides to invest $200 a month into an S&P 500 ETF using her Roth IRA. She sticks with it month after month, rain or shine, and after 15 years, she's contributed $36,000. But thanks to consistent 10% annual returns and the power of compounding, her portfolio could be worth over $60,000. Now here's the exciting part. If Sarah continues contributing just $200 a month and lets that investment ride until age 65, her total contributions over 35 years would be about $84,000, but her portfolio could grow to over $500,000 by retirement, tax-free if she's using a Roth IRA. That's $500,000 from what started as just a couple $100 a month. And life happens. Maybe Sarah has to pause contributions for a few months due to a job change or emergency. That's okay. The key is to start again as soon as possible. Even with small amounts, staying in the game matters more than being perfect. That's the power of starting early, staying consistent, and letting time do the heavy lifting. Now let's take a second to talk about the fear factor, because I know what some of you are thinking. Is now really the right time to invest with all the market volatility, inflation, and talk of recession? It's easy to feel uncertain, but here's the truth. Historically, the best returns often come from the money invested during uncertain times. Market crashes like in 2008 can temporarily reduce your portfolio, but staying invested historically leads to recovery. So don't wait for the perfect moment. It doesn't exist. Start now, even if it's just with a small amount. And you might be wondering, should I only invest in the S&P 500? For many people, the answer is yes. A simple portfolio built around a low-cost S&P 500 ETF is a rock-solid core strategy. I personally love VU from Vanguard and have made it the core of my own portfolio, but there are many great options out there. These are all low-cost, highly diversified funds that essentially track the same index. Check out this slide here showing 5 or 6 of the top choices, and you can compare them for yourself. You might choose to diversify. Some people layer in SCHD for dividends, QQQM for tech growth, or VXUS for international diversification. Let's take a quick detour and talk about long-term investing behavior. One of the biggest advantages of ETFs like these is their ability to help you stay the course. When the market drops, it's tempting to panic, but history shows us that selling during a downturn is almost always a mistake. If you had invested $60,000 right before the 2008 financial crisis and left it alone, you would still have come out far ahead by now. It's not about timing the market, it's about time in the market. S&P 500 ETFs make that easy. They don't require active management. They don't demand your attention. You just keep investing and let compounding do the rest. Here's another angle to think about: flexibility. Hitting that $60,000 goal doesn't just build your retirement nest egg, it creates options. That money could help fund a sabbatical, help you switch careers, start a business, pay off debt, or cover major life expenses. The more you invest now, the more freedom you have later. That's what financial independence is all about. And if you're worried about being too late, let me reassure you, whether you're 25 or 55, it's not too late to start. Sure, starting early is ideal, but what matters more is that you start at all. Even 15 or 20 years of smart investing can dramatically change your retirement picture. S&P 500 ETFs are simple, powerful, and time-tested. So here's your plan. Take the 401k match, automate your investing, optimize your cash flow, stay consistent, and aim for your first big goal, your initial $60,000 invested. And remember, I'm not just saying this, I'm doing it. These ETFs have been the core of my own portfolio for nearly 2 decades. I still buy more every single week. This strategy works. If you're ready to take the next step, open a brokerage account, pick an S&P 500 ETF that fits your goals, and start building your future today. I really appreciate you watching, and if you want to avoid the biggest ETF investing mistake that could cost you thousands, click on this video right here, and I will see you in the next one.